Hello everyone and welcome back for another summer school video. This time we are focusing on how to pick a stock. Before we continue, there are some questions we need to answer, which hopefully the previous videos from the summer school can help you with. We need to know how active we want to be, how long we want to stay in each investment, and we also need to know our risk appetite. As a quick recap, if you are an investor who wants to be more active, or you can be more active in the market, you might want to pay more attention to economic cycles, earnings reports, and fundamental changes for stocks. However, if you are not looking to be too active because of work or other commitments, knowing all of the above, it's not essential to make your investing decisions, and your focus can be much longer term. Also, when it comes to risk appetite, are you someone who wants to take more or less risk? Those who favour more will be more drawn towards stocks which offer the potential for more reward, whereas those who are more risk averse will focus on stocks which might have limited upside, but importantly have lower downside risk. An example of that could be dividend paying stocks from the long-standing established companies. On the flip side, someone looking for bigger returns may look to tech stocks for a greater potential return. If you are someone who is thinking about certain stocks to invest in but aren't quite sure where to start, it can be a good idea to think about investing in the brands you love and use. Now, of course, just because you love a brand, it doesn't guarantee it will be a good investment. But by thinking about what people will be doing in the future can be useful when deciding on these investments. So what kind of questions can we ask ourselves? Well, we might say, what kind of cars do I love? Or see people driving a lot, or think in the future that a lot of people will be driving. You might think electric vehicles will become ever present and like Tesla, or think in the future more people will be driving them. You might ask yourself, will people still use Apple products, wear Nike clothes and trainers, eat Domino's and McDonald's and so on? These could all potentially be companies that continue to grow over time. When it comes to investing, I'm constantly thinking about the future. What areas of the market do I foresee growing in the future? It might be electric vehicles, renewable energy, drone technology, crypto, or cybersecurity, for example. A really useful piece of advice for investors on eToro is to check out the smart portfolios that focus on similar themes as those just mentioned and many more. You can either invest in those directly or check out what companies are involved in each theme. For example, I might really believe in drone technology and that it will kick on in the future. So I check out eToro's smart portfolio for the drones and see what companies have exposure to this industry, such as Boeing, Microsoft, Intel, and General Electric. I can then potentially make a decision on these and other individual stocks if I wanted single stock exposure. Next up, let's talk more about analysis. When looking to choose a stock, we can put analysis into two broad categories: fundamental and technical analysis. Fundamental analysis is where investors will look at all the available data to then make a decision about whether they think something is over or undervalued. What investors might do in order to pick a stock can include looking at a company's earnings report and their forward guidance. To keep it very basic, if a company has a good earnings report and has optimistic plans and goals for the future, as an investor, you might see this as a good opportunity to invest. On the flip side, if a company reports a bad earnings for the previous quarter and they are not too confident about their future growth, this would be a stock an investor would be more likely to leave alone. For short-term investors, where we are in the economic cycle or macro environment will be key to their decision-making process. For example, if we are headed into a recession, investors will look at key data metrics to confirm this and maybe move their investments from riskier stocks to more defensive ones that perform better in this environment. For those who want to stay up to date with what is going on in the markets on a weekly basis, Ben Laidler, who is the eToro Global Market Strategist, does a webinar with myself every Monday where we talk about what is currently driving markets and what could do in the future. When it comes to analysing the stock to invest in, some investors will use technical analysis to try and time the market more precisely. We have loads of super useful free resources on the eToro Academy, and we also have free weekly webinars where we discuss potential opportunities. Technical analysis is essentially an approach to investing or trading where we look at previous price market data to try and predict potential outcomes. So whilst past performance isn't predictive of future results, a great saying is, history doesn't repeat itself, but often it rhymes. There are a few areas of technical analysis that can be useful for investors. Understanding support and resistance, which are essentially areas in the market where buyers and sellers have either entered the market previously or could enter in the future. Technical tools, candlestick and charting patterns can also be worth looking into, especially if you do want to time the market better. However, if your focus is super long term, it is not the end of the world to have limited understanding of technical analysis. Technical analysts do have to be aware of a couple things, however. They need to be sure that other investors are looking at the same thing as them, and they also need to be aware of any fundamental developments, as fundamental analysis will outweigh technical. Another useful thing to think about when picking stocks is diversification. I'm sure you've all heard the saying, don't put all your eggs into one basket. Well, for investing, it is the same. You don't want to put all your money into just one stock. Remember, we can't guarantee it will go higher, but by investing in multiple assets, you reduce portfolio risk. So as investors, we might want to have 2 or 3% invested in each company rather than having 50% of our investment account invested into 2 stocks. If you invest 50% of your account on one stock and it performs badly for whatever reason, it's going to really hurt you, and certainly a lot more than if it was just 2%. There's no secret sauce for the perfect amount of stocks to have in a portfolio, and it's completely up to you with what feels comfortable. But just remember, being diversified can be a useful risk management tool. From a personal perspective, I never risk more than 5% of my investment account in one particular stock. When it comes to managing our investments, it can be helpful to set some rules in place. Firstly, you have to remember why you got into the investment and for how long you roughly plan to stay in it. Once you have decided that, then we can put our rules in place. The most important thing to say is, if your reason for investing in the stock has not changed, then stick to your plan, especially if you're a longer term investor. There is nothing worse than getting out of an investment early for whatever reason, and then looking back in a few weeks or months and it did exactly what you thought it would. Has that happened to you? Because I used to do it so many times at the beginning of my investing and trading career, and it's so frustrating. In order to prevent this from happening, I created some rules. Has anything about the company changed from a fundamental perspective? Has the long-term global macro environment changed enough for me to come out of my investment? Have similar stocks performed in a way that might lead to my investment struggling? If the answer is no to these questions, then I stay in my position. Thinking longer term and having patience is key. The last thing you want to do as a long-term investor is to exit an investment after 2 months for no reason other than the price hasn't gone higher straight away. Have patience and remember your goals. To help with this, the next video we are going to cover is all about psychology. Don't worry, it won't get too touchy-feely. We will go over how best to manage our investments and how to remain focused on these long-term goals. See you next time, but right now, it's time for tanning.